So the discount rate is basically the lender of last resort rate. That's what the Federal Reserve should have, at least according to Bagehot's theory, Walter Bagehot from the 1800s, economist, late 1800s now, I'm sure of it. The Economist, chief editor for like 20 years, he's not a fan of central banks either. And again, I'm not defending central banks, but he said you should at least, you're supposed to lend for, it's the famous thing that he says, lend freely as a lender of last resort on good collateral at penalty interest. That's what he says. This was not what they were doing here. I know I'm not showing you any other market rates. I've done a daily on this. I'll get you some commercial paper in the future. I'll put it on a show. They were just lending like a normal bank. Many banks were just going to them like a normal bank, and the Fed knew it was a problem. And by the way, the Great Depression happened during this period, so they never really admitted it. That's you can see it's people know this pattern, right? Interest rates rise because inflation's running hot. The market collapses. They drop interest rates. Look at that. It was 7% discount. They dropped it to 3% in the roaring 20s. All right, skyscraper index exploding, stock market exploding. Irving Fisher, 9 days before this happened, said stocks have reached a permanently high plateau. This is one of the founding economic wonks of like, we can control money supply and prices and all this stuff. And then you see what happens. So famous last words.
So the interest rate the Fed pays,
yes,
is that based on the income they make by lending out to other banks? It's like if they're paying an interest rate.
No, the payment rate, which you might have heard, I think Lynn Alden's pointed this out as well, which is good. Like Ben Bernanke used to say they never lost a cent on their open market operations. They are losing money now, like in a big way.
Yeah.
Because the interest rate that they're earning on their securities, right? Because they have assets, liabilities. This is the total assets are in green. I'm not breaking it up, but just think bonds. Here it was more banks. They actually had bank loans that they were getting back in interest. But that's way different. The teens and 20s are way different than today. Here, it's government securities. They're getting lower interest rate. Now it's higher as it's been rising, but it has been so low, they've been getting low. And plus they're paying interest on reserves, which I mentioned before. They've only started doing that since the Great Depression, the GFC, the global financial crisis, the global financial crisis. They've only been doing that in the last 15 years. So they have interest coming in from their assets. Mm-hmm. They have interest going out that they pay banks, which they never did before. But now they're negative on that.
Why did they not do it before, and why do they do it now?
Because that's never would have been the way that banking would have worked. I mean, banks don't centralize and just keep things at the bank. The reason they did it, the reason that this exploded here, this reserve, let's just take off the balance sheet. This is the key. This reserve, this reason this thing exploded, where banks go from literally having 20 billion. You can see that number in the tooltip, 20, 30 billion. We don't even have to zoom in and see the tooltip. That's so small. And then just exploded to trillions, going to 2.5, 3 trillion. The reason that they did that was to bail out the bank's bad bets. But they knew that typically in banking, as it's always worked for the prior years and all the time, again, free banks or unfree banks, it always works this way. You make money by going short your depositors and going long loans. So you get money in from your depositors, all right? And you go long on loans. You lend depositors money out. That's just how it works. You'll make the spread. As that golf saying, it's like lend it, I don't even remember now. It's like borrow at 1, lend at 2 on the course by 3 or something. But it's higher than that typically. Typically it's 4 and 5%, which you would even have to borrow at. And then you lend at a little bit higher, something like that. You make a spread. I'm just throwing out numbers right there. It is true that there's another point. The history of interest rates, Sidney Homer, it's a tome. He's studied interest rates for 4,000 years. Never have interest rates been as low as they were here in World War II. They're at a 0.5% discount rate, I'm showing. Now the Fed funds, I'm going to answer your question eventually. The Fed funds gets up to over 20%. The discount rate gets to 14%. Never, you'd have to go back to ancient Greece to find that, even farther, like ancient Sumer, never been that high. And then now we know where they've been, and we know the problem. So 0%. They've gone in the last 100 years, the central bank, the premier banking institution in the United States has gone to 3 extremes. Never, ever has happened in recorded history, except like 20% in ancient Greece.
And they increased their balance sheet they increased their reserves to bail out the banks. But what is the makeup of that?
Yeah, so that's literally cash. Like they're taking the bad securities. They bought these mortgage-backed securities. also treasuries. So the banks have treasuries always. They bank, but the treasury always issues bonds in the open market. The banks buy that stuff for like pension funds, hedge funds. That's just how banking works, right? It's always this leveraging up on credit. Like someone issues, like the treasury, banks buy it. They will take the interest from the treasury, pay a little bit less to their depositors. That's just how banking works. That's capital markets.
And then
it's not a crime. It's not a problem.
And from 2014, they were paying it off. They were clearing it.
They were tightening.
Oh, tightening. Yes, yes,
so they're
yes.
tightening, but which
This
essentially
is that QT, which is a bullshit term that they come up with. The same with QE, it was a bullshit term. Like this is QE1. You can see right here very clearly. Dear listener, it was like 10 billion bank reserves. Then it goes up to $1 trillion 2 years after the GFC. Then it goes up to $1.6 trillion. This is QE2. Then it goes up to 2.7.
But
that's QE3.
Their bank reserves are essentially debt.
It's a liability. It's a liability for the Fed. It's an asset for the banks.
Yeah.
That's how it works.
But for the Fed, it's kind of a debt.
Any bank could do this. It is exactly a debt. It's a liability.
So you call it a Federal Reserve, but it's a federal debt.
Yeah.
Yeah. Okay.
They held no gold. So by the way, let's put the balance sheet back on. Reserves on the liability side. So I'm taking that off because it's kind of confusing. I could make these charts where they have liabilities on the bottom and assets on the top, but I'll get there eventually. This is the total balance sheet, total assets. There's securities on the asset side. There's the money on the liability side. That's how it always works, by the way, in banking. So remember what I said before. Debtor, you're a depositor in the bank. The bank is a debtor to you. You are a creditor of the bank. So you count up the liability. That means the bank has a liability to you. Your deposit represents a bank liability. So the way you want to calculate money, fiduciary media in the economy is always counting up the liability side, interestingly. So this is what people say, like it's debt-based banking or whatever. Like this, it is. Money is always comes on the liability side first. Again, not a problem in the free market. If you fail on your own bottom. But this has been centralized for the last 100 years. Anyway, there was another question, even besides Danny's, that you had, and I'm not sure I answered.
So why does the Fed need to clear its reserves? Why did they do QT?
You mean to decrease it?
Yeah. Can't they just
Well, they
those
say,
reserves
they
forever?
could. They could, and they certainly are. I mean, look in the last, I think actually they just posted as of this morning, it's still down a little bit more, but you can't actually see it when I'm zoomed in.
But is it because the banks themselves need to clear their debt with the Fed? So there is that natural process.
No, that has nothing to do with it.
No.
It's up to their discretion. So this is
why
base
do
money, by
QT?
the way. This is the whether we say balance sheet or the reserves. I'm not showing the notes. The notes make up the vast majority of the difference here. There's some other things too. They have this reverse repo facility now, which is kind of for non-banks.
I've got another question on that as well coming up.
Sure.
But why do QT? I get QE to stimulate the economy, but why do QT if it risks?
They say they want to normalize the economy. They know it's not good and everything. The reason in any other system, you see how low this is. Look, they're not even at $1 trillion by the GFC. Not even $1 trillion, $900 billion balance sheet. Now we're at trillions. They never got to 9. That must have been a voodoo number. So last year, they never got to 9. It was like 890, 892, 891. They never got to 9 trillion. Must have been a voodoo number. Then the Powell tried to cut it down. And by the way, he reversed 50% of that in the last 3 weeks.
Yeah.
So it's back to money printing. But anyway, the reason why we never had hyperinflation here is not a interest rate I'm showing on this chart. Unfortunately, I'll do a daily on this soon. It's this interest on reserve. So what effectively that did is Uncle Ben, Helicopter Ben, said, okay, we know that you made bad bets. All right, this is a problem. We're going to bail you out. We're going to credit your account with reserves. We're going to give you all the reserves you need to make your books better. This is these trillions of dollars. But we don't want you to lend that out. Because in normal banking, look how small the reserves are here. You see how small these reserves are as a portion of the balance sheet of the Fed. Remember, the rest is paper notes, most of it, during this time, most of it. So we don't want you to lend that out because we know it's going to be massively hyperinflationary. So I'm going to pay you, this is that expense that Lynn's talking about, I'm going to start to pay you more than the market, so you don't actually, you just keep those reserves. So effectively, it's just a bailout. It's kicking the can down the road, but they know, I mean, it's been talked about for years. It's been 15 years now that this has been going on. They know that this is not going to be an easy unwinding of this problem. And so this is what they're doing.
All right. So and I know I'm not the only one who thinks this because I've asked it a few
Sure.
times and people have commented back. But
Did I answer your question?
No, you did.
Okay.
Today,
Keep asking.
Today has given me the clearest picture of the relationship between banks and central banks to a point I never fully understood before. A few things have been sliding into place. I was like, okay, and Lynn Alden's brilliant, but sometimes having the chart has explained it to me.
That's great to hear.
So it's been a
seeing it on pictures is much easier.
Now I get those relationships. Reverse repo.
Okay.
Do you know? I'm going to ask you.
Reverse repo always confused.
Let me answer Danny's question first because we're still on. So this is good. I'm glad we're jiving here with this. So discount rate. You see the discount rate? So here, this is really interesting. I just did a video on this, so it's top of mind. The discount rate is in black. You see it?
Yeah.
And the Fed funds now, they started to publish it. It's a weighted average rate in the 50s. You see it's in the orange. You see that's below the discount rate. This is actually perfect Walter Badgett theory of banking. Again, Walter Badgett's not a fan of central bank. I'm not either. But he said, if you're going to have a central bank, lend at penalty interest to good collateral, to good banks, and lend freely if there's a crisis. That's the idea. Of course, the Federal Reserve doesn't know the interest rate, but this is this is what he says. They actually adhered to this. And I wouldn't necessarily call this a penalty, but you can see it's the high end. Okay, like if you're listening to this, you see a black line that's above and just little spikes down of the Fed funds. And so now what is the Fed funds? This is the rate that banks lend their reserves, the dark green shaded area, to each other. And why would they do that? Well, remember I told you the example of a billion pounds in checks going to you, whatever that bank, NatWest, $1 billion and one coming to me at Lloyd's. There's a £1 difference. Not a good example because you don't need to borrow money for one.
Yeah, but
sometimes you need to borrow money to cover that because you have reserve ratios, you have all these collateral ratios, all these other things. So at day end, if one bank is short on reserves, they will borrow them.
And do they do that from the repo market?
Yes and no. Yes and no. The Federal Reserve is now more involved in the repo market than it ever has, and I'll show you that. I got to go to the other chart. So let's not confuse it though, because they've never traditionally been involved in the repo market like that. The repo market, all it means basically is when you're going to have treasury securities trade like cash. That's what you need to think of the repo market. Okay, so the treasury, let's take the reserves out. Now I'm talking about the asset side of the Federal Reserve's balance sheet when they buy assets. All this light green stuff. All right, you see it. You see it on the screen, dear listeners. There's just a chart going from the lower left way to the upper right after the GFC. All of on the asset side is mostly securities. If banks hold those securities, now we're not talking about the Fed, but the other banks, they do the same thing. Okay, they have securities as well that they buy. Sometimes they sell them to the Federal Reserve for reserves. Sometimes they buy them from the Federal Reserve, and then they give the Federal Reserve reserves, and that destroys money. That's what's happening in the last couple of years before COVID and in the last year. Anyway, I know it's hard to conceptualize all this stuff, but this is how the fiduciary system works. This is how banking works. And if a bank outside of the context of the Federal Reserve wanted to have more liquidity, they could, and particularly non-banks even. And this is actually another point I wanted to bring up, is particularly money market funds. Okay, and money market funds, what is that? That's just a stable coin. You got to think of a stable coin. Mm-hmm. Stable coin is actually more like a euro dollar because it's a money market fund, but it's outside of the control of the central bank. So that's what a euro dollar means. It's a dollar-based account in France or UK or whatever. There's euro sterling. There's euros, but they don't call it that because it'd be stupid. It has nothing to do with Europe, by the way. The euro dollar, it has nothing to do with Europe. It just means dollars outside of the US, and it took the name euro dollar because of post-World War II, Americans were rebuilding Western Europe. So people wanted dollars. Anyway, if banks want, and banks and really non-banks were the big players in euro dollar markets, primarily money market funds. If they wanted to get a little bit more interest, they could repo a security, and they're actually reverse repoing. That's confusing, but I'll pull up a chart to show you. They're actually the reverse repo. So money market funds have the asset, they have the liquidity, and something like a hedge fund, it's not a bank. It could be a subsidiary of a bank, or like a Lehman, which failed, and they weren't really a bank, investment bank. Mm-hmm. Investment bank, not a traditional bank. If they are the repo party, So that's what Eurodollars are. It's basically you have securities, but you want a little bit more liquidity. So I'm going to collateralize it. I'm going to put it as a loan and I'm going to start trading it like cash. The physical security, it's not like they're wiring it back and forth, but they're trading the balance. The best way I think in the Bitcoin land is to say, like, imagine you have an account at Kraken or Coinbase, or who's your sponsor? Gemini. You got an account in Gemini. You want liquidity. Instead of putting more Bitcoin in or something, you're putting in US Treasuries to your balance. So you are adding US Treasuries, and then you can do more stuff. You can short, you can go long more, you can lever. It's more risk. And by the way, notice it's pure rehypothecation of a Treasury bond, by the way. It happens in banking all the time. Again, the free market would catch it better. It happens even more in the regulated system. Basically, you have a Treasury. Who pays interest on a Treasury security? The United States Treasury. They got to pay. And what does that really mean? It means the taxpayer. So the taxpayer pays interest. What happens with the repo? The repo is, well, the repo parties get together, say a money market fund and a hedge fund. They say, let's do a repo. The money market fund takes the reverse position. They have the asset. The hedge fund takes the liability, the repo position. Again, always count money from the liability side. The hedge fund has the liability. There's just, it's a short-term loan, but bottom line is it's called a repo. They are doing it for liquidity purposes on the one side, get a little more interest from the money market fund, and for also liquidity purposes on the liability side. The hedge fund wants to borrow.
So it's lend. Collateral kind of.
Yeah,
it's collateral. It's a short-term collateralized loan.
Yeah.
But the reason you do it is to take on more risk.
Yeah.
So again, the Treasury pays interest, but then you repo that Treasury further into the market. Someone else is now paying interest on top of it. So the repo party actually still is usually going to be the hedge fund. They'll have the security. They have securities to repo. They say, hey, I got a security, let me repo it. So they still get some interest from the Treasury, but then they got to pay more to the money market fund.